Hey, good morning and welcome. We appreciate you guys joining us today. I'm Danny Ratliff here with Lance Roberts. This is our June Candid Coffee edition. So do want to do a bit of housekeeping today. Number one, you guys have been here before. Y'all know the rules. We are Clarity Financial, doing business as RIA advisors. We are a registered investment advisor with the SEC. Anything you hear today is not specific advice. It is strictly just us talking, shooting the breeze a little bit here today. But if you do have any questions, you need any help, please don't hesitate to ask. Go to the comment section. We're happy to answer questions. Guys, you did a great job. We've got, I've got like 8 pages of questions. So y'all have given us a lot of material. If you're new, thank you for joining us. If you've been here and this is not your first rodeo, thank you again. We're going to cover a lot of information today. We're going to cover, some topics. We'll probably not get too deep in the weeds, but, we're going to try to get to as many of your questions as we can. This is we created this during COVID. It was kind of like an office hours. So just an opportunity to ask questions. Really happy that Lance can join us today. It's kind of funny, Lance, we talked about, this was perfect timing, kind of a mid-year review and all this volatility with the markets, so many concerns. And, we were talking this week, the market has climbed a wall of worry, and yet here we are at all-time highs again. Mm-hmm. And so interesting dynamic. I thought we were going to have a lot more volatility, and you'd really be getting ringed up right now, like, Iran, Israel, tariffs, the list goes on, taxes, but yet all those things seem to have subsided a bit.
Well, yeah, look, we've definitely had some volatility on January the 7th, we published an article on the website entitled Curb Your Enthusiasm. And the point of that article is that after 20% return years, we're very likely going to have a year of more volatility and lower rates of return, which has certainly been the case this year. We had a 19.5% drawdown in March and April. We'll probably have another drawdown August, September-ish, somewhere in there, maybe 3 to 5% as well before we kind of get that year-end rally. So, we may wind up about where we are now, maybe slightly higher. Returns this year might be sub 10% by the end of the year. Completely normal, but after 2 years of 20% returns, that'll certainly seem a little bit disappointing. But, the one thing that, there's a lot of these bearish narratives out there. It's like, oh, tariffs are going to cause this problem. And, dropping bombs on Iran is going to cause this problem. And we're going to have $150 barrel oil because of this problem, whatever. The problem is that none of these topics are impacting the only thing that really matters to markets, which is forward earnings expectations. Those continue to be very strong. They continue to be very optimistic. We're not seeing big impacts from tariffs, et cetera, impacting corporate earnings analysis and corporate earnings assessments. So that's why the market's continuing to look past these narratives and focus on what matters, which is what's ultimately going to be earnings.
Yeah, and that's true. And so, going into July, what are your expectations moving forward? I think there's so much uncertainty, and there's a lot of people that have still been out of the market or that have been in much reduced exposure. Mm-hmm. So how do you navigate that getting back in? I know we're a little bit more nimble, and we've got a lot of questions on portfolio allocation and kind of rebalancing. So I do want to get into that a bit. But what do you envision and how do you manage this volatility that we've seen over the last 6 months, really last couple of years? You can see I lost all my hair due to this.
Well, it's like, so first of all, if you go to our website, or you can follow me on Twitter at Lance Roberts or X, whatever they call it these days. Also on Substack, we post everything there at Substack as well, at Lance Roberts. But in today's newsletter specifically, there's a whole section on, well, what do I do if I miss the rally? Because that's the hard part, right? So we had this big sell-off in April. On April the 7th, we wrote an article talking about why that was likely the bottom of the market. The title of the article was The Hope and the Fear. And we had such record levels of fear in the markets. In fact, just despite that we only had a 19% drawdown, peak to trough, you had fear at levels that we haven't seen since the financial crisis. So you had just this massive, envelope of fear over the markets, all based around tariffs mostly. And, typically that's a great contrarian indicator. So we bought some stocks at that point, and, we've had a nice rally since then. And we just recently added some more stocks just this past week, just as markets had consolidated since May the 12th. Markets have really gone nowhere. And then on Monday, following the bombing of Iran over just last weekend, was where we bombed Iran. On Monday, the markets opened up and we've been running up to new highs ever since. And so, that was a good kind of, that breakout of that consolidation was a good entry point to add some exposure. Here's the thing about markets that people get wrong. You'll hear a lot about, markets are overbought, markets are this or that or whatever. Buying stocks, we don't necessarily want to buy stocks at lower prices. That's not the goal of buying stocks, but that's the way we think about it, right? Like, this stock has run up a lot, and so I don't want to buy it here because it's overbought. And so I'm going to wait for it to pull back to, $20 less than it was, where it was maybe 6 months ago or whatever. That's a mistake. We're not trying to buy stocks at lower prices. We want to buy stocks at a better risk reward basis. So, for instance, let's pick a stock, Palantir. That's one that's been on a big hot run lately. So, pick a stock, any stock, it doesn't matter. And if the stock goes sideways for a period of time and it consolidates a previous advance, you may pay today a higher price than what it was 2 months ago or 3 months ago when it started its consolidation. But now your risk reward of entry into that position is now better than it was previously, even though the stock's exactly the same price. So again, when you miss out on a rally, a lot of people are kind of caught up in this. They go, well, I just got to wait for the next correction, and so the market keeps going, the market keeps going, the market keeps going. Finally, they get drug in, just emotionally they get drug into the markets, and that's typically where the next correction is about to start, because now they just kind of capitulated. This is why investors typically, they buy high, they wind up selling low. So it's important to control emotions. But then it's also important to understand what's the goal of what I'm trying to do here, which is I just want to buy stocks at a better risk reward basis. And that does not necessarily mean lower prices. Those are two different things.
Yeah, well, I think that we always hear, and it does hold true, buy low, sell high. And it is probably the biggest struggle, but that's a good point because you do see that consolidation over time. And it's interesting. Palantir's been on such a tear. Yesterday, down a big day, down 10%. And all of a sudden everybody's like, "Whoa, should we still be in Palantir?" And I think that's a difficult one when we think about the day to day. But if you look back, like I had to go back and look at the portfolio last night, and I'm like, "Wait a second, we're still up like 68% on this position."
Yeah.
And needless to say, there's other reasons why that happened, right?
Yeah. It's changing indexes. So everybody that own Palantir in the small cap index, they've got to sell it. Everybody in the mid cap index is going to have to buy it now when it makes the transition. So you got to also look through when there's a big price movement. You have to say, well, why is this moving in this direction? The stock was really, really overbought. It needed a correction anyway. And so, there's a good example, but probably you've got a decent entry point set up for Palantir now. I haven't looked at it today technically, but there's probably a decent entry point. If you've been wanting to add Palantir, probably a good opportunity to add it to your portfolio. That's the way we bought a lot of stocks. We bought Palo Alto Networks when they missed earnings report because they missed their earnings. This was last year. The stock was down like 20%. We bought the stock on the dip because the earnings report was actually very, very good. But there was just a knee-jerk reaction to a comment that was made. Stock was down 20%. That was a great entry point for the stock.
Yeah.
So sometimes you've got to look past these headlines and actually get into the fundamentals of the companies. But that's what investing's about, is looking for those opportunities to deploy capital.
Yeah, no, absolutely. So, Lance, let's jump into some questions because we're talking about portfolio rebalancing. What does that look like? VJ had a really good question here. So, a lot of focus on timing the market since nobody knows what the future holds. Shouldn't we instead stay in the market with a portfolio that matches our risk appetite, provided the time horizon is 5 years or more?
That sounds like that's wonderful, great advice. That's awesome. Problem is you're not going to survive it. The issue, there's a lot of this commentary around. In fact, I've got an article coming out on absolute versus relative returns and talking about why you shouldn't benchmark your index. But in theory, that sounds great. That's the whole thesis behind buy and hold, which is I just buy an index, I don't pay attention to anything, and I just keep sticking money into it. Now, if you can do that for 30 years, you'll be great. You'll get average market returns over time. You'll be fine. The problem is always the case, is that we're too glued to the markets these days. If you can, for those of you that can literally not look at your portfolio every day, and this year's a great example of that. January the 1st, if I invested $1 million on January the 1st, and then I didn't look at my portfolio until July the 1st, I'm up 4% for the year. It's a good year so far.
Yeah.
But the problem is we're so glued to the markets and headlines and all this media stuff that goes on, all these narratives that are out there, is that you're going to get emotionally sucked into selling your portfolio or making changes because of some event that's happening somewhere within that 5-year time horizon, and you're going to wind up, selling low or buying high, and that's the impact that occurs to all investors over time. But this is one thing we wrote an article just previously. If you go to our website, search up the word anchoring on the website. We wrote a whole article about anchoring. And the problem is Wall Street wants you to compare. And so this is why for some reason, we look at our returns from January the 1st to December 31st, which has absolutely nothing to do with anything. But that's what Wall Street wants us to do, because that way say, oh, you underperformed last year. You need to move your money to this manager because he did better last year. But that's the worst thing you can do, because that's going to get emotionally going to drive you into buying high and selling low. And you're swapping strategies probably at the time that they're going to start working or stop working. But this is why you should look at your portfolio over a 3-year period. It doesn't matter what happened yesterday. It doesn't matter what happened the day before or the month before or even the quarter before. Where are you today versus where you were 3 years ago? And when you start looking at your portfolio over a longer term basis, you'll be able to manage and navigate your portfolio risk much better going forward, because you'll strip out a lot of this volatility and say, I'm still fine. Yeah, the markets were down 19%, but I'm still up 70% from where I was 3 years ago. I'm completely on track for my retirement goals. I'm good. So yeah,
Well,
start looking at longer term time horizons. It's much better for you.
but I think it also goes much deeper than that, Lance. So if we start thinking about that, you go back to 2000, you're investing, you stopped investing in the year 2000. How long did it take for you to get back if you're in the S&P 500, just sitting, right?
Yeah.
And now if you're in distribution mode, you're drawing down on an asset. So it goes a lot deeper than just the portfolio. I think we have to look at the plan. And so, do you have sufficient funds set on the sideline to incur these bigger drops, right? Now, that was a unique scenario, right? 2001, 2, 3, negative. 2008, obviously, we all know what happened there, significant downturn. But then we have to start thinking about, okay, so you have those funds that you can draw down from that are not going to impact your portfolio returns over time. And then we go a step further. What is the objective for these funds? If the objective is, hey, we're right now, we're still contributing, we're able to take advantage of these lower prices, then yes. But also markets shift and change so much quicker than they used to. And you hit the nail on the head, right? The headlines. Everybody's got access. Everybody pulls their phone out and, nonstop, we're getting an update. And I wake up with, I don't know how many updates on the phone, right? I'm sure all of you do the same thing, where it's now you hear about the information travels at almost the speed of light. But if we're in it, and so one big mantra, and I think big financial firms are going to tell you, is that don't worry about it. Set it and forget it. We're going to be diversified. We're going to invest in large cap, mid cap, small cap, international, emerging markets. And regardless of the situation, we're going to stay there because we really don't know what's going to happen. And there's some truth to that. And if they, I always pick on international when we're talking with people and I say, look, if they're going to say international is 15%, if they like it, they're going to move it to 18. If they don't like it, they'll move it to 12. Well, our thoughts are a little bit different. If we don't like something, let's remove it altogether. And it doesn't mean you don't go back to it. You don't find a better entry point. But dynamics shift so quickly. I mean, Lance, we talked about our trading. We've traded so much more frequently in the last couple of years than we ever have. Yeah. And it's been dictated on the market dynamics. It hasn't been this, prolonged, albeit if you stretch it out over time, you get this prolonged bull market. But, you get 2020 at 35% decline. 2021 is a great year. 22, we all know what happens, right? There's no place to hide but cash. 23, you get another, decent year. Market breadth wasn't great. But then you get, unless you're just all in techs, and 24 has been good. This year's not bad. I mean, I think if most people, if we said, oh, hey, market's going to be up 5% through midway point, if we can say, multiply that at the end of the year, if you got 10, I think most people would be happy. And in light of all that's going on, that's a pretty darn good year.
Yeah. No, there's a question in the chat right now asking about, any commodities, mining, or streamers in the mix. And, those are fine assets to own as long as you understand that they are super cyclical and you're taking on an exceptional amount of risk by owning those assets in your portfolio. So if your portfolio is to generate a set rate of return over time, then you want and want lower volatility, you don't want to own those, because what's going to happen eventually, and probably not too much longer now, we've given the latest economic data. Once the economic data starts to really slow and we start pushing closer towards a recession, commodities are going to be underperform rather sharply. Gold's had 2 very, very good years, but it'll become a liquidity source for other asset classes when you start getting a rally in the dollar. So you've got to be careful with commodities in particular, because they have a much higher level of what's called beta volatility
Yeah.
relative to the market itself. And they're fine when they're working, and when they're working, people want to gravitate to those. They want to own them because they can make a lot of returns very quickly. But the issues with commodities as a function of a long-term portfolio strategy is that they can decimate your returns when you eventually get the next downturn. And those occur much more often in commodity bases than they do actually in stock and bond markets.
Well, and that's great, Lance. I know, conversations you and I have about this, especially when we talk about commodities in general. If we're owning a pure, like if you're owning gold, you're owning silver, a lot of people are flocking towards that, right? I mean, every other ad you see is for gold or for precious metals. And, while they don't pay interest, but you look back, cyclically adjusted, they don't look nearly as good as what a lot of other areas do. And so if somebody's looking to add that type of exposure to a portfolio, what do you typically say, like, hey, here's a good ballpark to earmark towards from a percentage perspective of liquid net worth?
Well, no, I mean, it depends on what your risk. We talk about risk tolerance all the
Yeah.
time, and there's some people that have a much higher level of risk. They're okay with a 20 or 30% drawdown in an asset on a very short-term basis. So that's completely fine. If you're able to withstand that and not make an emotional decision, I'm down 30% in this, but I understand the dynamics of this. I understand, what this means, how economics are going to impact this, or how, financial are going to impact that, whatever. Then that's fine. And you can certainly have a higher weighting of that in your portfolio. And, you'll probably, if you manage the risk right, you'll probably do fine over time. What happens for most individuals is they wind up, for instance, they're chasing gold right now because gold's had a fantastic 2-year run. But if you look at a periodic table of returns of asset classes over time, what you'll find out is that whenever an asset class runs at the top of the return structure for 1 to 2 years, it typically winds up at the bottom of the return structure over the next 1 to 3 years. And it's just these. Then this is all asset classes. It's gold, it's stocks, it's bonds, it's whatever else it is. And it's just how markets work, because markets rotate between asset classes. And so whatever's underperforming is typically the things you want to start really eyeing on. Say that's really been underperforming for the last couple of years. There's probably going to be a really good opportunity to own that asset much cheaper. Again, that's our goal, right? To buy stuff cheap, and then sell it when it's expensive. Yet, what are we doing right now? Investors are all chasing the most expensive asset classes on the basis of some narrative, and they're selling the most oversold. So they're buying high and selling low at the same time, which typically doesn't work out well. Now, timing of this is always the issue, right? Is it 6 months, a year from now, 2 years from now, before you get this rotation in the market? The timing part, you never know. But again, what we do know is that investors are right now, in particular, buying the most overbought classes and selling the most oversold, which is exactly the opposite of what they should be doing.
Yeah, so maybe go in a little detail on like the sector rotation, and we have these conversations each morning with our investment committee. How we look at that maybe a little differently than most.
Yeah, well, sector rotations is crucially important if you're managing your own portfolio. Just for instance, so if you read this weekend's newsletter, there's a whole section on sector analysis, and right now, staples, real estate, utilities, sorry, is the third one, are some of the most oversold right now. And, technology communications, because of the last, the run we've had really since the April lows, are the most overbought. So what'll happen is eventually you're going to get profit taking coming out of technology and communications. There'll be some headline, something comes out, earnings season, whatever it is. You never know what the case is going to be, but there'll be something that causes the majority of the technology sector and the communication sector to sell off. And that money will rotate to the most oversold sectors, which right now are like I said, we did a whole highlight on the staples sector. Procter & Gamble, Kimberly-Clark, Clorox, these are very, very oversold companies right now that have very good, strong fundamentals. So there's this eventual rotation from risk on to risk off will occur within the markets, and it happens all the time. We had this same conversation back in January and February, and talking about how the markets were extremely overbought. You needed to take profits and reduce risk. And then, of course, we didn't know why there was going to be a correction coming, but we laid out this whole case for a correction in the markets. And then, of course, we have March and April, right? And so it's just a function of how markets work. The problem is we kind of get very myopically focused on a certain asset class because it's going up, and we disregard the risk that we're taking to own that asset class in our portfolio. And we talk a lot about risk management, but risk is not about how much money you make. It's about how much money you lose when you're wrong. Risk is awesome when you're making money at it. It's like going to Vegas and betting, all in on every hand because you're getting a royal flush every hand and at the poker table. But eventually that luck's going to turn. And the same thing happens in the markets. And of course, when you lose a lot more than you gain. And that's always the problem for investors over time.
Yep, no, I agree. And I think that's the struggle that everybody's dealing with at the moment. All right. So let's shift a little bit. There's a lot of questions we've gotten on, do we intend to add Bitcoin and gold? So not a major shift here. What are your thoughts in general on that? And here's the problem with this, guys, is that whatever we say, we're going to make somebody upset and mad here. Because if we say we love it, so you're going to be like, you guys are idiots. If we say we don't like it, you're going to say, oh my gosh, you guys are idiots as well. So it's really tough to kind of be middle of the road on these. And Lance, I think that, you can probably answer this question as well as anybody.
Sure. Well, no. So in terms of gold is fine. It's been in a very strong bullish trend. And again, whatever we say today is going to change. And this is one of the big challenges with people that email me, right? I get a lot of emails from people like, what do you think about this stock I own in my portfolio right now?
Yeah.
Well, I can tell you right now that stock is really overbought and it's going to have a correction, or it's really oversold and or something's broken with it, whatever. And then I'll get an email about 8 months later. And it's like, well, you told me to sell this stock and now it's higher than it was. Well, I didn't tell you to sell everything to start with, but also I didn't say you couldn't buy it back at some point, right? So you go back and look at the chart. There was a decent correction in the stock because it was overbought, and then it's had a decent rally since. So whatever we say about gold and Bitcoin right now is only right now, just today. And again, things are going to change in a month, 2 months, a quarter, a year. Things will be different. So, and our opinion will change over the course of time as well, based on what's happening within those markets. But, like I said, gold's had a fantastic run. It's been up 2 years in a row. Gold is a form of where you store foreign reserves. So if I'm a foreign government or if I'm a foreign investment fund, I have three choices to store my reserve currency, especially if I'm a central bank. So I have reserve currency. Where do I want to store it? Well, I don't want to own bonds right now because the bonds have been underperforming for the last couple of years. Even though I'm getting a higher yield, I am not getting the return of capital appreciation on top of the yield versus what I'm getting owning sovereign debt in my own country. At the same time, I don't want to own bonds because as the dollar is declining, I am losing. I've got a bond price that's yielding 5, but I'm losing on the dollar depreciation relative to the currency in my country. Remember, the dollar is all about relative balances between two currencies. So I don't want to store my reserves there. Stocks over the last couple of months have not been a great place to store reserves as well. So we had this whole sell the U.S. earlier this year, and that's now reversed. But that was because the stocks were underappreciating or depreciating during March and April, and so reserves were coming out of stocks. Well, gold has been holding its value very well here, has been appreciating. So as a central bank, we've seen a lot of central banks buying gold because I'm not only getting the appreciation in gold, but I can also store my reserves there because gold trades in dollars everywhere in the world. So it's a store of reserve value. So what'll happen eventually, and this happens repeatedly over time, is that you're eventually going to get a reversal in the dollar sell-off. The dollar will start to rally. It's extremely oversold right now. In fact, there's a really good dollar trade setting up here. But you'll get a rally in the dollar, and stocks are already rallying. So you're already starting to see foreign reserves coming back into U.S. stocks. So eventually what will happen is that gold will become a liquidity source to buy stocks and bonds, because once yields start coming down because of weaker economic growth, whatever it is, and I'm getting a higher yield in U.S. treasuries than I'm getting in, say, the German Bund or the Swiss national bond, which they're now at zero interest rates, you'll see that money flow reversed. Well, I've only got three choices and of where to store my reserves: gold, bonds, or stocks. And so you'll see that liquidity source come out of gold, and it'll go into stocks and bonds temporarily. So that'll eventually happen, and then it'll reverse again. So again, it's just, gold is a commodity. It has no fundamentals. It has no asset. So I'm strictly trading on price. And the only thing that sets the price of gold is what happens on the NYMEX. So it's traders buying and selling gold and buying and selling gold futures. That's what sets the price. So you're basically just betting on the price of an asset. So as long as the asset price is going up, it's fine. And owning gold right now has been working well. We have a portfolio called the all-weather model, which has a very large allocation to gold. That portfolio is doing very, very well this year because of its gold holdings, plus its assets and stocks and other things that it owns. So, but eventually, that dynamic will change, and we'll have to reallocate our positions of gold in that portfolio because that will start becoming a drag on the portfolio. So we'll have to shift from gold holdings into stock holdings at that point, and mitigate the risk of the decline that we start getting out of that asset class. So again, nothing wrong with owning it. It's fine. Bitcoin's the same way. Bitcoin is a proxy for the stock market, so it has a very high correlation to stocks. So as long as the stock market's going up, as long as there's speculative greed and excess in the markets, which we have right now to a large degree, Bitcoin's doing great. And it's going to continue to do well as long as there's a lot of speculative activity in the markets. And we have a record level of speculation in the markets right now. We have call options that are literally at the highest level we've ever seen in the history of the markets, and not by a small amount, by just leaps and bounds. We've never seen so much retail speculative activity in the stock market as we see right now. And that's helping really support the price of Bitcoin as well. So again, that's doing fine. Bullish trends are fine. Technicals are fine. Nothing wrong with owning Bitcoin right now. But just understand that it will eventually, when there is a correction in the market, Bitcoin will correct more than the market on a percentage basis.
Well, Lance, that's interesting because we've always heard, and we're actually still hearing from a lot of different pundits that Bitcoin is the safe haven, right? It's a store of assets. How can those two go hand in hand?
Well, look, that's a narrative, right?
Yeah.
It's just an asset.
Yeah.
So I can buy Bitcoin, and if it goes up in value, great, I make money. If it goes down in value, I'll lose money. So that's all there is to it. And it's not money, right? And so one of the things that you'll hear about with gold and Bitcoin in particular is like, it's money. It's not money, because money by its very definition is that I can use it for the purchase of goods and services. That is, it is basically a legal tender authorized to represent the value for the purchase of goods and services. That's what money is. If I have to convert something from what it is into dollars, it's not money. So if I want to use my Bitcoin as an example, or my gold, to go buy a cup of coffee at Starbucks, I've got to convert it into dollars before I can use it. So therefore, it doesn't meet the criteria of money. But we assign all these things to it, right? Because we need to rationalize why we're buying this. But at the end of the day, it's just an asset. It goes up in value, it goes down in value. And as investors, all we care about is, can we convert our savings in and grow our savings at the rate of inflation or higher, so that the purchasing parity value of our dollars today are the same in 10 or 20 years. And it doesn't matter how I get there. I can do it in stocks, bonds, Bitcoin, gold. It doesn't matter how I get there. All I'm trying to do is take the value of my assets that I have today and grow them into a higher value in the future to offset inflation.
Yeah, no, that's a great point. So we're getting a lot of specific questions, and we typically try to stay away from like individual stocks. We can talk about broad markets in general, just because everybody's scenario is much, much different. But we've got a couple, through the last week or so on, all these questions here, but also on energy. There's a big narrative around energy, AI, and I think the narrative may be more so on maybe the nat gas, data centers. How do you power these things? What are your thoughts in general? Just a 2-minute synopsis on that.
So power generation is a big thesis in our portfolio right now. Actually, our artificial intelligence is becoming a much bigger thesis in our overall portfolio right now, but not just from the companies that are developing AI like Google, Microsoft, Apple, Amazon, Palantir, but also the power generation infrastructure side of AI as well. Michael Leibowitz just posted part 1 of an article this past week on what's called behind the meter. And this is, the big problem that we have is that as we build out data centers, they require more and more power. They require an excess amount of power to generate the power needed for these data centers. Now, data centers are not not the traditional data center that we were building back during the internet phase, where we were just building warehouses of computers where you could put up a website and they would be racked up inside this warehouse of other websites. That was the technical term for a data center back then. We're not building data centers. We're building AI factories. And the way that you scale profitability with an AI factory is to build bigger factories. And the bigger I can build my factory, the more money I'm going to make. So there's going to be 50 data centers built. These AI factories are already in the process of getting built. That will expand to 100 over the course of the next 10, 15 years. But these factories are going to be have a massive demand for electricity outside of what the current power grid can deliver. So what they're doing is what's called behind the meter. They're basically directly connecting, bypassing the electric grid and directly connecting to a natural gas pipeline. So a lot of these data centers are getting built very close to natural gas pipelines. Now, eventually they'll get built very close to nuclear power centers, but it takes about 10 years to build a nuclear facility. So that'll come next. So you've seen companies like Oklo and Cameco and those stocks do. And a stock we own, for instance, as an example, is GE Vernova, which is in that space. They're doing very, very well right now. The problem they're going to run into is the long lead time of getting those nuclear facilities built. And so there's going to be this lull in earnings, and those stocks are going to be really volatile until we get to the end game of that. In the near term, the demand is going to be on natural gas. So, we're adding companies to our portfolio like Kinder Morgan Energy, et cetera, that have very strong presences in the areas where these AI data factories are getting built, because they will tap into those pipelines and go behind the meter. So, like I said, Mike Leibowitz has got part 1 of an article up right now on the website. Part 2 will be up next week, explaining that thesis more in detail.
Yeah, Mike's done a really good job on that. He's also talked a lot about the dollar. And so we've gotten a lot of questions on the dollar, obviously decreasing in value. Maybe I think there's some misconceptions surrounding that. Talk a little bit about how we view the dollar.
Well, the dollar, there's all these narratives out there. It's like, oh, de-dollarization and all this stuff. None of that's true. There's actually no value of that information in the narrative whatsoever. In fact, if you take a look at the dollar since 1980, it's higher than it was in 1980. It's on a nice bullish uptrend for the last 40 years. Does it go up and down in value over time? Yeah, absolutely. And it's going to, because it's all about relative value. When you look at the dollar, you don't look at the dollar in terms of a dollar. You look at it in terms of its relationship to other currencies, either another currency specifically, the dollar versus the euro, or the dollar versus the yen, or you look at it, the dollar relative to a basket of currencies. The important thing to understand about the dollar is that that's the representation of trade. So if the dollar gets too overvalued relative to another country, let's just pick, country A, the U.S. versus country A. Both of those should trade at an even dollar, right? So if the trade value is equal between the two countries, they can trade effectively without a currency impact. If the dollar gets too strong, their currency, which is now weaker relative to the dollar, will no longer purchase as much as they could before. So things become more expensive because their currency is depreciating, increasing the value of the imports they're getting from the US, or vice versa. So when the dollar becomes unbalanced relative to another currency, then we see currency manipulation step in. This is where a country will, they'll depreciate the Chinese yuan, they'll depreciate that, or do things to appreciate the value of the yuan to lessen the negative potential impact for their country. And so we see these currency manipulations step in. And again, the goal is ultimately to get these currencies to be somewhat relatively balanced. The dollar so a couple of years ago in 2022, we had this big decline in the dollar, and there was all these stories about de-dollarization and the end of the U.S. reserve currency and blah, blah, blah. We wrote a ton of articles about why that was complete nonsense. And then we had a very, very strong counter trend rally in the dollar, and the dollar went to some of the highest levels we've seen in recent years. And all of a sudden those stories faded. Now the dollar has basically got extremely overbought. It was reversing that very overbought condition relative to other currencies, which was impacting trade between these countries. The dollar's been coming down, and all it's done is just basically give up some of that previous advance and is getting back in line with other currencies, which is now allowing for better trade between countries. And now the dollar is extremely oversold. So we, as is always the case, we kind of go from one extreme to the other. And there's a very good setup right now, technically speaking, for a very strong counter trend rally in the dollar. And what will happen is, again, that will be a function of inflows of foreign currency into the U.S. to buy stocks, buy bonds, buy whatever, buy oil, buy gold, which is all traded in dollars. As those foreign inflows come back into U.S. assets, that increases the strength of the dollar. So again, that'll happen. That's just a function of time. But all these stories, still, 70% of global transactions occur in the dollar. There is no other currency you can use to execute transactions, import trade transactions, because no other currency is deep enough. No other currency is liquid enough. No other currency is stable enough. No other currency has the rule of law. So, or the defense mechanism to back it up, which is the military. So, that's just a function of time until you get a counter trend rally in the dollar. But the dollar's fine. It's still, still very, it's still in a nice bullish uptrend on a long-term basis. There's a lot of these stories really don't carry any weight whatsoever.
Yeah. So in fact, if you go to realinvestmentadvice.com, go to the search bar on the right at the top, type in death of the dollar. Michael Liebowitz actually wrote some really good articles, a couple, was it like part 3 or 3 different sections of that, that actually go through that in quite a bit of detail. So that's great. Another big question, and we're going to get to that. Then we're going to get to bigger, broader kind of generalities on, portfolios. How do you look at that from a, we talked a little bit about rebalancing, but I want to talk a little bit about, we're getting a lot of questions on like, how would we manage funds in different environments? And how do you break, Steve, I get it. You say, isn't the theme of this supposed to be how to be independent from the media and Wall Street narrative? And yes, in a lot of ways, right? And we're going to discuss that. But we're also addressing a lot of questions here. So, the big question we've had for years is the narrative on bonds, right? We own some long duration bonds. We do believe that over time, interest rates will go down. Obviously, I think we were in it a tad bit early, but, we continue to get fiscal and monetary policy stimulus over and over and over again, which was unprecedented. And now, we're in an interesting spot. The Fed likely probably cut too early. And now they're kind of sitting tight, waiting on this transitory inflation, right? Do you think we should cut now?
Yeah, I just wrote an article about this yesterday. It's on the website now, talking about the Fed's transitory outlook is incorrect. But you made a misstatement real quick. We don't trade bonds. And this is a big misnomer when we talk about bond exposure. People think we're trading bonds. We don't trade bonds. We own bonds in portfolios because we run allocation models. So when the client comes to us, they say, hey, I'm a conservative investor. I'm looking for a 3 or 5% annual return in my portfolio to meet my financial goals. Well, if I split a portfolio down the middle, I say 50% stocks, 50% bonds, then I get 5% of my bonds. So if my goal is a 5% return on an annual basis, I split my portfolio in half. 5% treasury bonds gives me a 2.5% annualized rate of return right off the bat. I know I'm going to get that because that's the yield. That's the income from the coupon of the bond. So I've already got 2.5% of my 5% locked up. I put the other 50% of my portfolio in dividend yielding stocks that are giving me an average yield of about 3%, which is our structure in our portfolios. Then I'm getting another 1.5% from the dividend yield of those stocks. I'm going to get that regardless of what the market says. So now I've already got nearly 4% of my portfolio of my 5% return already locked up in the portfolio just from interest income and dividends. So all I need out of my portfolio now is I need stocks to go up 1% for the year. That's not a hard challenge to do. I can do that on a very low risk basis. So we run these allocation models, 60, 40, 70, 30, 80, 20, whatever it is. If you don't want to own bonds, we can run you a 100% equity portfolio. That's completely fine. But if you come to me, Danny, if you come to me as a financial advisor, say my client needs a 60-40 allocation model, they're going to own 40% bonds. Now, we structure that bond portfolio to be underweight duration, so it is less sensitive to interest rate changes. So we're capturing yield. We have about 5% of the total portfolio actually in longer duration bonds, so we can capture a little bit higher return on the coupon payment. But a big chunk of that is between 1 and 5 year maturities, within the portfolio. So we have very little duration risk in the portfolio, which lowers overall volatility while capturing, especially with 2 years and 5-year notes yielding nearly 5%, I can capture that income return for the portfolio. But we're not making a bet on the outcome of buying bonds today that we're going to have this big, massive capital appreciation. That's going to occur at some point, because as inflation falls and as the economy moves towards recession, which we just saw some of that data in the latest PCE report, we're rapidly slowing down in the economy. So as the economy slows down, inflation is going to fall and bond yields will fall, and causing bond prices to go up. So people that own bonds now will generate capital appreciation as yields come down, and so they'll have a higher total return. But that's not the goal of owning bonds. The reason we own bonds is because they guarantee the return of principal at maturity and give us a guaranteed income stream over the life of the period of time that we're owning those bonds. So no, we're not trading bonds. We're owning bonds for specific portfolio management reasons.
So that's great. You think rates are going down?
Yeah, no doubt.
Yeah. And I'm not gonna press you on how quickly, because Lord knows what can happen between here and there, and things are going to change. And that's the struggle right now with thinking about lower interest rates. We could have made an argument for a long time that rates should be lower.
Well, no, interest rates are trading exactly where they should be right now. If you want to know where, so let's take the 10-year Treasury rate. Where's the 10-year Treasury rate trading right now? I think on Friday it closed right around 4.3%. Okay, so let's just use that number. What is inflation right now in terms of the CPI report? It's roughly about 2.3%. Economic growth as of, if you include the first quarter, which was negative 0.5, we're trading right around 2% economic growth on an inflation adjusted basis. So if you take 2 economic growth plus 2.3 in inflation, that's 4.3. What's the interest rate on the 10-year Treasury? It's 4.3. So interest rates are trading exactly where they should be. So, but as the economy slows, and again, we are definitely seeing that in the data, then yields will come down because inflation will fall. So if inflation goes to 2%, as the Fed wants, and it'll likely go lower than that, and the Fed's target for GDP growth is 1.8%. So that's 3.8. So we should see Treasury yields trading somewhere in the mid threes by next year. In theory, if the economy slows at the current rate that it's going, we will see lower yields on bonds. Now, everybody's expecting yields to go back to zero or to 0.5%, which is what we saw the 10-year Treasury rate during the pandemic. We're not going back there until we get into another financial crisis type situation. Yields should never trade below the rate of inflation and economic growth. So you should never trade below 2% in theory on the 10-year Treasury rate, but unless you're in a financial crisis. But if you're trading somewhere between 2.5 and 3.5, that's probably about where what we call the terminal rate on bond yields are going to be as the economy slows down towards a more recessionary type status over the next couple of years.
Okay, great. All right, so we're gonna pivot here quickly. Brent, if you will pull up the wheel of names. So if you guys have not seen, we love you guys being here with us. We're gonna give away one of these Candid coffee mugs, maybe a couple if we've got time. I'm slacking on the job. Should have been doing this earlier.
What I win.
All right. Doug, we'll have somebody reach out to you. Thanks for joining. We'll get you a mug here shortly. So want to touch on some softer stuff, but I do want to touch before we leave at some point, Lance, on the portfolio in general, as far as, I always explain it's kind of like an accordion, right? We can expand it when things are going really well. We can condense it, have capital on hand to reinvest at lower prices if we are in a recession or a bear market, so to speak. So we're more geared towards, we want to mitigate risk on the downside, participate on the upside. And so, going back, Steve, you mentioned, financial independence. We believe a big part of that is, breaking away from the Main Street and saying, or being more mainstream, breaking away from Wall Street in the sense of that buy and hold strategy is not designed for you and I. That buy and hold strategy is great if markets are always trending up, but it's easy to manage. We'd probably have a lot more hobbies, Lance, if we manage money much differently and set it and forget it and said, we're going to completely diversify, kind of like we alluded to earlier. But I think the struggle is that finding that, sticking to a discipline, and that's something that we have to deal with on a regular basis, is how do you find that discipline? If you're managing money on your own, what does that mean? How do you not let emotions get involved and kind of take it away, right? That's when we notice if we don't follow that discipline, we can get in trouble. And so we stick to it. Talk briefly about maybe how that's much different than a more cookie cutter, set it and forget it approach.
Well, so you know this because you used to work for J.P. Morgan back in the day.
Oh yeah, for sure.
Yeah. What big companies want. So Schwab, Fidelity, J.P. Morgan. And look, I'm not bashing these guys at all. So don't take what I'm about to say as I'm just talking bad about the big boys. They have very big businesses, and literally hundreds of thousands, if not millions, of clients to deal with on that. And so they physically cannot manage portfolio risk effectively doing that. So their best advice is, hey, diversify your portfolio, put your money into this, basket of stocks or ETFs or whatever. We're going to charge you an annual fee on that. And this was an annuitization of the business stream that Wall Street created back in the early 1980s. Prior to 1980, there was only a couple of mutual funds. There were a few mutual fund companies, but not many. And what occurred in the 80s, and back then, we had stockbrokers, and most of the transactions done on Wall Street was, your broker called you up and said, hey, I think we should buy, General Electric, and you'd execute trades, you could charge the commission for that, and then you would own that stock. And the average holding period for stocks back then was about 6 years. But the problem with that is in order for Wall Street to make money, they have to make sales every day. So the broker had to get on the phone, had to call a client, get them to buy something today. That's how they made money. And, it was really a fair structure between the client and Wall Street. You could opt to buy it, you could not opt to buy it, didn't matter. But everything was pretty well balanced. But Wall Street goes, what, this is too much work. And if we want to scale, we have to annuitize our income stream. And so they came up with this idea for mutual funds, and they saw these mutual funds that are out there which were just charging, like 3% on an annual basis to manage this fund of assets. And they go, well, if I can take that and scale it, every year, if I've got, $1 billion under management, I can walk in on January the 1st and know I've already made $100 million this year because of my fee that we're charging. So, regardless of what happens with the fund, I'm going to make $100 million this year because of the fees we're going to charge. So they figured this game out, and we've gone from mutual funds to ETFs, and they figured out that if I can just convince you to buy this basket of whatever it is and hold it and just collect the fee from you, then I really don't have to work as hard, right? I can just have a bunch of advisors, which are technically just salesmen, call up and say, hey, you need to invest your money in the markets, and just look. If you look at this long-term chart of the market, it always goes up, right? So you have no risk. Well, the problem is we know that you can have 20% corrections, 50% corrections along the way that can have very big impacts to your outcome in your investing portfolio. And I'll just ask one question of you. So if you're in the chat right now, if buy and hold works as Wall Street promises that it does, why is it that 80% of Americans can't make ends meet, can't come up with $1,000? If everybody just invested money into the stock market, everybody should be rich, theoretically, according to what Wall Street tells you. But it's not, because as individuals, we do all the wrong things in investing. We buy high, we sell low, we don't buy and hold. We are always trying to mess with the edges. We get greedy, we start chasing whatever's going up, we sell whatever's going down. We make all the wrong decisions. And that's why outcomes are never as what is promised. So, and again, markets don't provide annual rates of return. Another big kind of Wall Street line is like, oh, just invest in markets, you get 8% a year. No, you don't, because markets don't deliver an average rate of return. Some years you get higher, some years you get a lot lower. And if you look at the differential between what markets actually return versus what was promised as a 6% or an 8% compounded rate of return, that gap is massive, because the markets do not compound. Any single year of loss destroys any compounding effect you had in the markets. So again, this is why we focus on risk management. We focus on mitigating losses as much as possible. We're not going to mitigate all losses, but our goal is to reduce the downside draw so that we can more quickly recover and get back into positive territory and have the portfolio start making money again. And we've done that effectively and well over the last several years.
Yeah, thank you for addressing that. So we're going to jump into some other topics here real quick. One thing that we get a lot of questions on is tax planning. And, one thing that is a struggle is that I think a lot of times everybody's hoping for a magic wand. Like, how do we just avoid taxes in general? And we get a lot of times clients will call in or somebody will call in that, they've already retired. All the funds are in pre-tax. So it becomes a challenge. And, luckily we do have, so required minimum distributions have changed a bit. It used to be that at 70 and a half, we were required to take funds out of those qualified retirement plans, 401ks, 403bs, IRAs. And we've got a little bit of a break. They moved it to 73. Actually, they're going to start having it on a sliding scale where we get in 2033, it goes up to 75. So it gives a little bit of opportunity to start making distributions before you're required to. Now, I get it. Look, a lot of people are just required to do so just to make ends meet, not because the government's telling you. But there are ways that we can look and say, how do we maximize a tax bracket? How do we take X amount? Like, give you an example this year, if you're married filing jointly, a lot of concerns about IRMA, right? Medicare premium surcharges. You can make up to $212,000 and not have that 174.80 go up like $75 for you and your spouse. And so we can very strategically go in and then make a plan to look and say, okay, here's a distribution strategy over the years. And, some of that will be, thinking about legacy planning. So we're kind of going off here on a tangent a bit, but it is one of those bigger picture items that we have to think about. Do you look to leave a legacy? What does that look like? How's the best way for you to do so? What tax brackets are we in? How can we maximize those without going higher and then incurring additional taxation, right? Keeping more money in your pocket is another side of what we do. So the financial planning side goes hand in hand exactly with all the things Lance is talking about. All that portfolio management is really critical and super important. And what Lance and I and our team and Richard and everybody behind the scenes, what we do is we marry those two together and say, okay, your risk tolerance is X, but your objectives are this. Can we meet that? What is your hurdle rate? Lance has alluded to that earlier. What is the rate of return that you need to get for your return to be successful? But somebody mentioned in the notes a bit ago, the psychology of investing, Lance. And we always joke that a lot of times we need, we've got all these certifications in house and degrees and many, many years of experience managing money, but we really probably need a psychology degree half the time, just because and we understand that this is something that it's very close to many people, that this is your livelihood. This is what you saved your whole life for. And so we take it very seriously on the portfolio management side, but also on the other side, what is the best way to take Social Security? What does Medicare look like? We actually, so much so that we've taught classes on Medicare. Rich and I have done that for years. In fact, he's certified to actually, offer Medicare now. And so that's something most people don't know that we can do. And so utilize that. We're going to send a survey out here after this today. Please fill it out. Let us know what you guys think. Let us know other topics you want us to cover. We're going to do Retirement Blueprint on July 19th with Rich and Jonathan. So that's a great presentation. It's going to be a little bit more defined than what we're doing here. We're just bouncing ideas back and forth. But that's a good one for kind of what does retirement look like in general? How do you navigate that? On the other side of things, we're also going to cover Social Security in August, Medicare in September. So lots of different webinars. But, the question always we get, Lance, is like, how do we avoid those taxes? How do we create income in retirement? So spend just a minute on the retirement aspect and creating a retirement portfolio, because you and I were actually talking offline this morning about, what does that look like? Because we get a lot of questions on investment vehicles. And I think everybody wants to reinvent the wheel, and Wall Street does a fantastic job on, packaging products. You talked about this a bit ago and saying, oh, okay, hey, look, this is this theme, or this is, here's the next best, greatest thing. They want money in motion. So talk a little bit about, what is an easy way to create a retirement portfolio?
Well, that's the thing, is that, what we wind up doing is we wind up making things way more complicated than they need to be in most cases. And, so we tend to overthink stuff because we're so inundated by all this stuff coming in the markets. It's like, hey, here's this ETF that, has an option strategy attached to it. And it's got this really high yield, but then you look at the performance of that versus, the S&P, and it actually underperforms. You always have to ask yourself, well, why is it that I'm trying to own this? And we wind up starting getting trapped into all these psychological pitfalls. Like I'm trying to chase stuff with the highest possible yield. Well, if I can get something in my portfolio that yields 10%, and that's going to, I'll just put all my money in that, and I'll get 10% a year, and I'm good for retirement. The problem is you have to understand the risk you're taking. And so a lot of times we just start overthinking these things, and there's so many different products that are coming to markets. And, one of the big topics we had this last week on the show was, there's a big push by private equity companies to get into the public markets. So retail investors want access to private equity. Why do they want to give it to you now all of a sudden, right? Why now, after all these years, is Wall Street in such a rush to get private equity to mainstream media? Could they potentially be running out of asset flows that they need to support private equity on their side? There's a lot of questions that surround that. So, but the question is, how much risk are you taking, and what's going to be the impact of that in the future? So we have all this stuff thrown at us constantly, but for most individuals, it comes down, again, you're talking about psychology a minute ago, it comes down to our psychological pitfalls, loss avoidance, hurting, all these type of things that we talk about. But for most individuals, all they need is a portfolio of good, high quality, dividend yielding stocks that have good, strong fundamentals. Yeah, you may not own the Palantirs of the world, you may not own the Oklos of the world or whatever, that you look at the headline and it's like, oh, the stock's up 500% over the last 6 months, whatever. You may never own one of those, and that's okay. There's nothing wrong with not owning those companies, because that's speculative risk. And at some point, as we saw in 2022, the market was down about 20% ish in 2022. The average retail investor was down nearly 40, because they were owning a lot of speculative risk in their markets. They were chasing the ARK funds of the world. They were chasing all, the Rokus of the world, and all these type of stocks that got decimated during that 2022 downturn. You didn't see it at the surface, because Apple and Microsoft and those, high quality companies were holding the market up. But underneath the surface, there was mass devastation. There were companies down 70, 80, 90% during that downturn in 2022. And so you had big impacts to portfolios, and that really hurt retirement plans. But again, this is why I like our all-weather model, which owns, high quality dividend yielding companies. It owns bonds, it owns some gold, it has some cash surrogates in it, but it just cranks out a real steady rate of return over time. And it's not volatile. It's not gonna knock the wheels off the markets when markets are going up, but it's not going to lose a lot of money when the markets go down. And that allows you to achieve a steadier rate of return over time, to make sure you're funding your retirement goals in retirement. I kind of laid out just a real simple example earlier about a 5% return between stocks and bonds. That's super easy to build, and it doesn't take a lot of work, and importantly, it doesn't take a lot of maintenance. It's pretty much a portfolio that once you build it, you monitor it every quarter, every 6 months, make sure nothing's falling out of bed. But it's a very easy portfolio to generate an income stream of 3, 4, 5% a year on. That's pretty easy to build.
Yeah. Well, we've got Larry over here talking about he's drinking out of a coffee pot because he has no coffee mugs. Brent, will you spin the wheel one more time, please? I'd hate for Larry to burn himself.
Yeah, well, it's not going to be Larry.
It won't. I know you, Larry. It's going to be somebody else. If it's Larry, I'm sending him two. All right.
Look, it's Larry.
Teresa Little, congrats. Thank you, Brent, for doing that.
Just send Larry a mug so he'll quit drinking out of a coffee pot.
I don't know. I want to see how long you can do this for.
Okay.
Larry, I know you give me a lot of grief online on the YouTube channel, so we're going to keep this going for a minute. We can return the favor here.
Yeah. See, even Colleen's saying just send Larry a mug.
All right, well, maybe if
you're in chat right now, if you think we should send Larry a mug, put 1 in the chat. And so if we get a majority of votes, I'll encourage Brent to send Larry a mug.
There you go.
And Larry, you can't vote for yourself. That's not fair.
That is true. All right, guys, we're coming up on the hour. We're going to go just a couple minutes. You got a minute or two?
Yep.
Lance, you good?
Yep.
All right. So one thing I do want to address, we did have an in-person workshop not long ago. And one thing, I know a lot of you guys are all over the country. Some of you may be all over the world. And we appreciate you guys for following. We do have a local radio show here in Houston, and that is actually going to change. When I brought this up, Lance, you could have heard a pin drop. He's like, what? It was not the response I expected, because I really expected most of you guys were on YouTube or one of the other outlets that you can find our information. So the format, we're still going to be in the mornings. We're going to be on YouTube. I encourage you guys, if you are listening to AM 700 in Houston, go ahead and get over there, like, subscribe. You'll get updates when we come on air. We're still going to do it in the morning. And it's going to allow us a little bit more freedom and flexibility. You guys want to have the commercial breaks. You're going to have a lot more flexibility. Lance is going to get back to interviewing a lot of really smart people, and we're going to be able to do a lot more. You want to add anything to that, Lance?
No, that's it. Is that, I've been doing radio for 25 years now. Actually, Brent was my first operations manager when I started radio 25 years ago. And it's been a great run on radio, but there's challenges with the signal and a whole variety of other things. And it's just now the world is kind of moving towards podcasts and YouTube videos, and we're now streaming on multiple platforms, and we're going to expand where we're streaming. But we have all your favorite podcast channels, whether it's Spotify or Apple iTunes or a variety of others. You can find it. We post a daily podcast for you. So if you have a podcast app, you can listen to the show there. We're streaming live on YouTube and X. We're posting our videos on Substack. So you can pretty much get access to all this content through all your favorite media platforms. And radio's been great to us. It's been an awesome adventure, but there's limitations to what we can do on radio, and having live interviews and doing that thing is much more challenging when you have these breaks set within the system. So it's going to give us the ability to do a lot more content, interview some really, like you said, interview some really smart people, do some different things, take in more chat questions and those type of things as well, and answer those. So we're looking forward to it. It's going to be a new adventure when we make this switch, but I think you're going to like the results.
Yeah, I agree. All right, I want to get to another question. We've got quite a few on this as well. Anne wants to know, so family offices for high net worth customers invest in PE and PC. If it is so speculative, then why do they put their customers in these alternative investments? And I think I want you to elaborate on this, but I also think it's a function of size and percentages, right?
No, private equity, there's nothing wrong with it, but you have to really understand what you're getting yourself into. And if you take a look at high net worth investors, they have about 15 to 20% of their money invested in private equity. And the reason for that is because yes, private equity can give you higher rates of return on average, and they advertise that it has lower volatility. But the only reason it has lower volatility is because it only reports once a quarter. The other problem with private equity for most people is that it's a 5-year lockup period. So once you invest your capital into that, you're stuck in it for 5 years before you can start getting capital out of it.
Or more potentially, right? And some are less.
Even more. Yeah, some of them are even longer. I've seen deals go 10 years. So you just have to really understand what you're investing into. And most importantly, you have to understand the statistics of private equity. Of private equity, about 90% of them have less than a 1% return or one-time return on it. In other words, you invest $1 million into a PE fund, you get your $1 million back, and that's about all you get out of it. Only about 0.4% of them have a 5x return. So when you hear about the Ubers and the Lyfts and those type of things that were taken in by these big PE firms, they get access to the very best deals. Those are where a bulk of those big transactions occur from, but you don't hear about all the ones that didn't make, the ones they lost money on. And those happen on much more often than you think. The whole goal with private equity is to invest in enough deals so that you lose on 7 out of 10 of them, and 3 of them make up all the difference, and you make money with it. But again, most people don't have that ability. So we've written articles. If you go to our website and type in either the word private equity or why am I so lucky, you'll get an article entitled just that, why am I so lucky? In other words, it goes through the private equity mix. And if somebody approaches you with private equity, there's some basic questions you should ask yourself up front. One, if you're not an institutional investor with a major PE firm, ask yourself, well, why is this deal not there? Because every good deal is immediately absorbed by people like BlackRock and Sequoia and these other big PE firms. Really good deals, the Ubers, the Lyfts, they don't see the general public. Those are immediately absorbed by these major PE companies. So if you're getting a deal, hey, you should invest in this company. It's got this great. Well, why didn't a major PE company pick this up already? Because it's not that quality of deal they're looking for. This is a second tier deal, maybe third. So your risk start to exponentially increase in the ability of that company to generate. So you just have to be careful to understand what you're getting into. Again, there's nothing wrong with them as long as you can do the analysis, understand the liquidity issues, understand the lockup periods, and understand that, there is a very high probability that that fund will not make. And as long as you're good with all of those and are willing to invest the capital with a risk of complete loss, then do it. Just understand what the risks are that you're getting into.
Well, I think the key is understanding the percentages of it and understanding that you cannot put all of your eggs in one basket when we're talking about private equity because of all those different reasons. So for the average person, right? You and I talked about this actually, I think Wednesday on the show. Younger generation feels like markets aren't going to keep up. And I don't feel like it's just the younger generation. I think it's everybody in a sense, which is odd because markets have done relatively well. Now, the key is all those things you just mentioned. How much do you put in? How much are you willing to lose? What's the liquidity that you need? The income that you absolutely have to have? Because if anybody out there, if you've done private equity, go put it in the chat. Have you always gotten your distributions? Probably not. Have you always gotten the funds when you needed? Probably not. Especially if you've got a lot of experience. And now you may have hit a home run on the first go round. That's great. But you have to be willing to hold and ride it out regardless of the situation because your hands are generally tied.
Yep.
So just some things to think about. Hey, so I know we're just past the hour mark. We appreciate you guys. There's still a ton of questions. We are going to go ahead and answer these throughout the next coming weeks. Lance is going to be on vacation next week. We'll be back the following week on air. Going to give Brent and Lance a little bit of a break. But if you have any additional questions, please don't hesitate to reach out. We're going to send you a survey. It's going to give you a link to answer some questions for us. Let us know how we did, what you'd like to see. I know all these questions were not addressed. Please let us know what you want to hear from. We're going to take it. We're going to start addressing these in the coming weeks. So stay tuned. Next event, you see it here, Saturday, July 19th. Also, if you'd like for an advisor to reach out to you and just kind of give you an idea of what we do, how we can work together, happy to give, you can actually fill that in the survey. Let us know. We'd love to work with you, get to know you guys a little bit better. And then from there, you can also see what we do on Medicare, insurance. All that information is going to be right there. But we do appreciate you guys spending time with us. We know it's Saturday morning. There's plenty to do. I don't know what the weather is in most of the country, but it is hot here. So anyways, Lance, any parting words?
No, I had a couple of quick questions. I don't necessarily always know when I'm going to be on Charles Payne very far in advance, but when I do, I generally let people know on X. So make sure you follow me on X at Lance Roberts. Also, I don't drive on vacations. We fly. So yeah.
Yeah. There's some stipulations we have for Lance when he travels now. He used to ski. We're like, no skiing for you. No snowboarding. No jumping out of planes. No, that destination looks a little too scary. Maybe, yeah. So we put him in some bubble wrap from time to time.
Yeah.
But anyways, guys, thank y'all. Have a great weekend. We'll see you soon. Happy 4th.
See ya.